December 11th, 2008. FBI agents walk through the marble lobby of the Lipstick Building in Manhattan. Upstairs, a 70-year-old man sits in his corner office watching his empire collapse in real time. In the past 72 hours, he's confessed to his sons that his entire business is one big lie. In the next hour, he'll be in handcuffs, and $64 billion will simply vanish into thin air. This is the story of the largest financial fraud in human history. A scheme so audacious, so perfectly constructed that it fooled Nobel Prize winners, Hollywood celebrities, and some of the smartest money managers on Wall Street for over 2 decades. But here's what makes this different from every other financial scandal you've heard about. This wasn't about greed, it was about fear. And the man who built it understood something about human psychology that made him nearly unstoppable. His name was Bernie Madoff, and what happened to his family will haunt you. 1960. A 22-year-old Bernie Madoff starts Bernard L. Madoff Investment Securities with $5,000 he saved from working as a lifeguard and sprinkler installer. His father-in-law loans him another $50,000. The company operates out of a small office, and Bernie does everything himself: trading, bookkeeping, even sweeping the floors. But Madoff has vision. While other brokers are still using pencil and paper, he's investing in computer technology. By the 1970s, his firm is processing trades electronically when most of Wall Street is still shouting orders across crowded trading floors. He's not just keeping up with the times, he's creating them. The legitimate business explodes. By the 1990s, Madoff's brokerage is handling 10 to 15% of all trading orders on the New York Stock Exchange. He becomes chairman of NASDAQ. He's invited to exclusive country clubs, serves on charity boards, donates millions to causes across New York. Bernie Madoff isn't just successful, he's untouchable. And somewhere along the way, he starts a side business, an asset management division that promises something Wall Street had never seen before: consistent returns with almost no risk. The pitch was elegant in its simplicity. Madoff claimed to use something called a split-strike conversion strategy. He would buy stocks in the S&P 100, then hedge those positions with put options to minimize downside risk. When the market got too volatile, he'd shift everything into treasury bills and wait for better opportunities. The returns weren't spectacular, around 10 to 15% annually, but they were steady. Month after month, year after year, Bernie Madoff's fund delivered profits while everyone else rode the roller coaster of market volatility. In 14 years of reported trading, his fund had only 7 losing months. And those losses were microscopic. The fund was exclusive. You couldn't just call up and invest. You needed an introduction, a connection, a recommendation from someone already inside. This wasn't some get-rich-quick scheme being hawked to desperate retriers. This was sophisticated money management for sophisticated people, and sophisticated people lined up to get in. Nobel Prize-winning economist Elie Wiesel invested his foundation's money with Madoff. So did Steven Spielberg, the owner of the New York Mets. Dozens of country clubs and charitable foundations. Hedge fund managers were supposed to be the smartest people in finance, handed Madoff billions of dollars to manage. But there was one person who wasn't impressed. A quantitative analyst named Harry Markopolos had been trying to reverse engineer Madoff's strategy for his own firm, and the numbers didn't add up. In May 2000, Markopolos submitted an 8-page analysis to the SEC's Boston office. His conclusion was stark. Bernie Madoff's returns were either coming from illegal insider trading, or the entire fund is nothing more than a Ponzi scheme. The SEC investigated. They found nothing wrong. 5 years later, Markopolos tried again. This time he submitted a 30-page report documenting 30 red flags based on 14 years of trading data. He showed that Madoff's claimed strategy was mathematically impossible to execute at the scale he was reporting. He pointed out that Madoff refused to allow independent audits. He demonstrated that the consistency of returns defied every known principle of market behavior. The SEC investigated again. They found nothing wrong. But here's what the SEC didn't know, and what would eventually destroy everything. Meanwhile, several major Wall Street firms had quietly stopped doing business with Madoff altogether. They couldn't prove anything was wrong, but something felt off. The returns were too smooth. The explanations were too vague. The whole operation was too secretive. But the money kept flowing in, because Bernie Madoff had discovered something more powerful than greed: the fear of volatility. Most Ponzi schemes promise impossible returns, 20, 30, 50% annually. They attract desperate people willing to believe in miracles. But Madoff's genius was promising boring, steady profits to people who were already rich. His clients weren't looking to get rich quick. They were looking to stay rich forever. And there was another reason the scheme lasted so long. Madoff had deliberately targeted a specific type of investor, charitable foundations and endowments. Federal law requires these organizations to pay out only 5% of their assets annually. For every $1 billion Madoff managed, he only needed to come up with about $50 million in withdrawals each year. At that rate, he could keep a Ponzi scheme running for decades without ever buying a single stock. Which is exactly what he did. Here's what was really happening inside Bernie Madoff's asset management division. Despite all the sophisticated talk about split strike conversions and market timing, no securities were actually being bought or sold. Client money went directly into Chase Manhattan bank account number 703. When investors wanted their returns, Madoff simply paid them with deposits from newer investors. Every monthly statement was fabricated. Every trade confirmation was fiction. Every 1099 tax form was based on imaginary transactions. For over 15 years, Bernie Madoff ran the most elaborate accounting fraud in history, creating fake paperwork for billions of dollars in trades that never happened. The scheme was elegant because it was simple. New money in, old money out. As long as more cash was coming in than going out, the machine could run forever. And for years it did. But Ponzi schemes have one fatal weakness. They require constant growth. The moment more money flows out than flows in, the entire structure collapses. And in 2008, that moment arrived. March 16th. Bear Stearns collapses overnight, wiped out by the subprime mortgage crisis. Suddenly, wealthy investors everywhere are nervous. They start pulling money out of risky investments and moving it to safer assets. September 15th. Lehman Brothers files for bankruptcy. The financial crisis that started with subprime mortgages is now threatening the entire global economy. Panic spreads through every corner of Wall Street. For Bernie Madoff, this is catastrophic. Between September and December 2008, investors request $7 billion in redemptions. But there's a problem. The money isn't there. By November, Madoff's Chase account has only $300 million coming in against $320 million going out. For the first time in decades, the machine is running in reverse. November 19th, Madoff can barely meet his redemption requests. He's desperate for cash, sending a 19-page pitch book to billionaire Kenneth Langone, begging for $500 million to $1 billion with a 1-week deadline. Langone declines. December 1st, Carl Shapiro, a 95-year-old philanthropist and longtime friend, wires Madoff $250 million in emergency funding. Madoff accepts the money knowing his scheme is about to collapse. December 4th, Madoff tells his lieutenant Frank DePascali that he's finished. He orders DePascali to use the remaining funds to cash out family members and favored investors. December 5th. Even as his world crumbles, Madoff accepts another $10 million from investor Martin Rosenman. The money goes straight into the black hole of his Ponzi scheme. December 9th. Madoff tells his brother Peter that the firm is on the brink of collapse. December 10th. Madoff calls his sons Mark and Andrew into his office. He tells them he wants to pay out $170 million in early bonuses from the firm's remaining $200 million in assets. His sons are confused. How can they pay bonuses if they can't pay investors? Madoff asks them to follow him to his apartment. There, he confesses that the asset management arm of his business is one big lie. Everything they thought they knew about their father's success was fiction. Mark and Andrew Madoff report their father to federal authorities that same day. December 11th, 2008. At 8:30 a.m., FBI agents arrest Bernie Madoff at his Manhattan penthouse. The largest Ponzi scheme in history is over. The aftermath was swift and merciless. Within days, investigators discovered that $18 billion in investor principal had simply vanished. Bernie Madoff pleaded guilty to 11 federal felony counts on March 12, 2009. On June 29th, he was sentenced to 150 years in federal prison, the maximum allowed under law. He died behind bars on April 14, 2021, at age 82. His brother Peter, who had worked with Bernie for 40 years and served as the firm's chief compliance officer, was sentenced to 10 years in prison. Frank DePascali, who oversaw the day-to-day operations of the Ponzi scheme, pleaded guilty to 10 felony counts, but died of lung cancer in 2015 before he could be sentenced. The victims included some of the most prominent names in business, entertainment, and philanthropy. Elie Wiesel's foundation lost $15.2 million. Steven Spielberg's Wunderkinder Foundation lost millions more. Dozens of charities that had trusted Madoff with their endowments were forced to close their doors. But perhaps the most tragic victims were Madoff's own family. His son Mark committed suicide on December 11, 2010, exactly 2 years after his father's arrest. His other son Andrew died of cancer in 2014, believing until the end that the stress of the scandal had contributed to his illness. The recovery effort became the largest financial fraud investigation in U.S. history. Irving Picard, the court-appointed trustee, has recovered over $14 billion for victims, more than 70% of their principal losses. The largest single recovery came from the estate of Jeffrey Picauer, a Madoff investor who died in 2009, which returned $7.2 billion to the victim fund. But some mysteries remain unsolved. Investigators never determined exactly when Madoff's legitimate business became a Ponzi scheme. Some former employees claim it started in the 1970s. Madoff himself said it began in the early 1990s. The truth died with him. What we do know is this. For over 2 decades, Bernie Madoff exploited the most basic human emotions, fear and trust, to steal more money than most countries produce in a year. He proved that the most dangerous fraudsters aren't the ones who promise impossible dreams, but the ones who promise to protect you from your nightmares. Today, if you walk past the building that once housed Bernard L. Madoff Investment Securities, you'll find something chilling. The offices sit empty. The name has been scrubbed from every directory, but on the 17th floor, if you know where to look, you can still see the faded outline on the wall where Bernie Madoff's name once hung in gold letters. A ghost sign for a ghost company. A reminder that the biggest lie in financial history happened in plain sight, fooled the smartest people in the world, and could happen again tomorrow. Because the one thing Bernie Madoff understood better than anyone else is that people will believe anything if you make them feel safe. And that's the most terrifying